Hi everyone, and thank you for joining us today for Galleria's investment seminar. We're really excited to bring you to this community. If you haven't been to our sales center, we encourage you to come by. This is one of the most exciting master plan communities in the GTA today. We're going to cover some of the reasons to really consider coming back into the market. We're seeing a lot of confidence return, investing in pre-construction, and of course, some of the reasons to invest in Galleria on the Park. So without much more ado, please follow me and we could cover the presentation. Thank you. So today, of course, we're here to talk about Galleria on the Park, but more importantly, we want to talk about the market and why does it make sense to invest in pre-construction again now versus last year. So we've compiled for you the top 10 reasons to invest at Galleria on the Park and really also invest in Toronto. Number 10 reason is Toronto is a leading global city. We rank second amongst 154 other global cities by A.T. Kearney, talking about the power, the strength that Toronto has in the post-pandemic recovery. And we're already seeing that today in the real estate market. There's a lot of heat coming back to the market. Low-rise has been performing really well for a while now. Condos are starting to come back true to form and so show some strength as well. Toronto also ranks as one of the top 10 most livable cities in the world, top 10 talent markets in North America, which is a really important statistics because what that shows us is that a lot of really talented individuals migrate to Toronto, make it their homes, and really strong workforce, really intelligent workforce actually also encourages employers, high-level, high-end employers to come into our market and create more employment opportunities. So this is actually something that's really important to understand. Toronto also ranks in the top 10 from cities that are the safest in the world, top 20 in the top performing global cities, and top 20 cities with a strong ecosystem for startups. And of course, we also happen to be the 2019 NBA champions. Number 9 reasons is the low interest rate environment. Currently, interest rates are sitting at 0.25% as far as the Bank of Canada overnight rate. The last time interest rates were this low, Toronto's real estate market has gone on an unprecedented 10 years of consecutive growth. So it's really important to understand that the government right now is doing everything they can to bring confidence and certainty and to prop growth back into the market. These rates are expected to remain in place for the next 2 to 3 years, and you know that with lower interest rates have a significant impact on demand. The lower the interest rates, the cheaper it is to borrow money, the more demand that generates for economic growth. Number 8 is the immigration influx. Canada ranks 4th in the world by migration. The government of Canada over the pandemic had announced that they are revising their immigration targets for the next 3 years, 2021, 22, and 23. Our new revised immigration intake numbers would total over 1.23 million new immigrants. You may not know this, but 35% to 40% of all new immigrants to Canada actually make the GTA their home, which means that over the next 3 years, Toronto and the GTA's population is expected to grow by over 400,000 people. Immigrants account for virtually all of our population growth in the GTA. And what that does, again, to real estate is it creates a heightened level of demand that otherwise you don't see in other markets across Canada or really in North America. More immigrants need more housing, which means we need to build more to produce more. And if we don't, which has been traditionally an issue in our market, we just don't produce enough, the demand is outpacing supply and prices continue to grow. Number 7 is our post-pandemic recovery. Benjamin Tal from CIBC had conducted a study that showed that Canadian households and businesses have $170 billion in cash reserves. Those funds will be deployed back into the markets along with the return of consumer confidence. Those two are interconnected. So when consumer confidence returns, more people feel comfortable spending money, and we do have a ton of money in cash reserves to be redeployed back in the market. Once that happens, the ripple effect economically is massive. Opportunities for employments, opportunities for investments, people just bring the confidence back into retail. All of these industries will come back bigger and stronger than ever. We're also now rolling out the vaccine. Now, granted, it's not going as we planned. It's getting through a little bit slower than we all wanted to, but we are getting better. And as the vaccine gets distributed, we're going to see the economic rebound happening more and more as people feel more confident to go back outside to interact with friends and peers and family, and the consumer spending in accordance with that would jump. With the international borders reopening, which is something that the government has already been discussing now that the vaccine is being distributed, that has a massive impact generally on the economy. Open borders means immigration, as we've just talked about. It also means tourism. We need the tourism industry to come back. We need hotels to host people. We need our tourism sites to host people. We need people to come and see how beautiful Toronto is. When that happens, again, more money in the economy. And then we also need the international students to come back. And when that happens, we're going to see a big resurgence and strength back in our rental market. Number 6 reason is the outdoor public spaces. Galleria, obviously being a master plan community with 8 buildings, has a ton of outdoor spaces that are wide open, they're pedestrian friendly, they're designed to engage with your community, with your neighbors, with the retail, with the park that's across the street. So the other outdoor gathering spaces offer unique retailers and cafes that entice people to make Galleria a destination all over the city. When you can create a community that becomes a destination, that's when real estate values really go through the roof. And that's the intention here at Galleria. The next few slides are going to talk specifically about the market, the economics, the strength that is in Galleria on the Park. So the first thing we're going to talk about our sub-market specifically is rent. Our sub-market rent, we've taken Galleria, we've drawn a 1 kilometer radius around Galleria, and we've compared it to another downtown location, Yonge and Wellesley, just to see how Galleria stacks up when it's compared to other downtown core location. From a rental perspective, units available at Galleria for rent right now in a kilometer radius are 22. There are only 22 units available for rent right now at Galleria. Comparatively with the downtown market, we have over 1,500 units for rent right now. The market for rent downtown right now is incredibly saturated, and that causes a lot of pressure on pricing. To put it in context, we have seen nearly 10 times the amount of units rent in the downtown core location, 10 times the amount of units that rent under $2,000 a square foot, under $2,000 per month. Last year, there's been about 300 transactions for rentals under $2,000 per month in downtown. In that same area today, there's been over 3,000 units that have rented under $2,000. So when you're buying something at 13 or 14 or 1,500 square feet, they used to rent for $2,400 or $2,500 per month, and now rents for $2,000 per month. It's just impossible to make that math work as an investor. Inversely, at Galleria, we're seeing statistics related to rent that we've never seen before. Obviously, inventory levels are low. Rental transactions during COVID have increased at Galleria by nearly 40%. Take that and compare that with downtown. Rental transactions downtown have decreased by over 50%. That's a 90% variance. Current inventory absorption period at Galleria, again, we're seeing it dropping to 59 days, while we're seeing it rising in downtown to 84 days. If you're a landlord right now and you have a unit for rent downtown, it is more than likely that you'll be sitting 3 months vacant before you're able to secure a tenant, and the tenant that you'll be securing will be at a significantly lower rent than what it was a year or a year and a half ago. Now you're obligated to carry that tenant at that rent with only minor increases through the life of their tenancy. So very little chance for upside for landlords. Units at Galleria rent 24% faster than units downtown. Rent at Galleria today is only 12% lower than the downtown core, but our prices are almost 25% lower. So what happens is you're buying a unit for almost 25% less, but you're renting it for almost the same amount as the downtown core. Significantly better value for your dollar, significantly higher returns on investments. Before COVID, the rental gap between downtown and Galleria was $525 per month. That was the average gap. Today, that gap dropped down to $267. It nearly dropped by half. Why? More people want to make the Galleria district their homes, while unbelievable and unprecedented amounts of inventory for rentals in downtown have put a ton of pressure on pricing. So what you're seeing is this kind of trend where you're spending less at Galleria, but the rent is more than, is nearly the same as it is downtown. Shifting to sales. How are sales tracking over the pandemic? So what we've done is we've compared a period prior to the pandemic, June 2019 to February 2020, before the pandemic, and then June 2020 to February 2021 during the pandemic. And here's what we're seeing. Right now, if you're looking for a unit for sale at the Galleria district, there's literally one unit listed. There is no supply. Now, as an investor, as a sophisticated investor, as a sophisticated broker, you always want to advise your clients, don't go where there's a huge amount of oversupply. As Wayne Gretzky said, the great one, don't skate where the puck is, skate where the puck is going. We've seen the puck at the downtown core. We've seen those markets really experience a tough performance during COVID, and at Galleria, we're seeing the exact opposite. We're seeing our market flourish, prices are higher, rents are higher. Sale price trends during COVID. So during COVID, Galleria has seen prices rise by 11%, while downtown has seen prices drop by about 3%. Again, 14% gap there in terms of performance during the pandemic. And that really talks about the resilience that the Galleria district, the Galleria market has. Average days on the market in Galleria dropped by 22%, while average days on the market in downtown have increased by almost 13%. Again, that's a gap of about 35%. Better to invest where the money is going to be, where the infrastructure investments are going to be, where the puck will be, come to Galleria. Our current inventory absorption period sits at only 3 days. Within 3 days, there will be no inventory available at Galleria on the Park. And if you take that and compare it to the downtown core, their absorption period sits at almost 3 months. So if you want to sell a unit at downtown, it's going to take you almost 3 months to sell it, while if you want to buy one or if you want to sell one at Galleria, it's going to take you about 3 days. Units at Galleria sell 55% faster than downtown. They are priced 23% lower than downtown. And we're seeing the sales activity volume rise during COVID at Galleria and drop during COVID in downtown. Next is the return on investment, which is an important factor. So we'll look at two things here. Number one is the deposit structure and the benefits of buying pre-construction compared to resale. So right now we have a special incentive where you can buy a unit in Galleria 1 and 2 with only 10 to 15% down until occupancy. Occupancy is scheduled for about 3.5 to 4 years from now. You can literally buy a unit that's $700,000 with only $70,000 or $100,000 down over a period of a year to 2 years, and then the balance on occupancy to 20%. Some of the benefits, you need less cash right now. The payments are staggered. It's generally about 5% per year, which makes it super easy for you to save. Lock in today's price for appreciation during construction period, which will take 3 to 5 years. You don't need to compete for current tenants in the current environment. Obviously, the rental market is trying to recover from a very tough period during the pandemic. Fortunately for us, investors at Galleria on the Park, investors in the Galleria district are not experiencing that slowdown, but you don't have to even worry about that for another 3 to 4 years. There's a buyer-friendly deposit structure, which we talked about, and we have some incredible special incentives, which we'll discuss as well. Here's how the investment breaks down. You can see 3-bedroom at Galleria. 3-bedroom unit at Galleria could be purchased for about $950,000. You would put down $190,000 as your down payment. Again, that's over a period of 4 years. Your projected monthly rent for 4 years from now is about $3,500. You'll collect about $45,000 per year. Your mortgage will be about $34,000 per year. We've built in the cost of the maintenance fees. We've built in the cost of the property taxes. We're adding back the mortgage principal amount because as you're making mortgage payments, you're getting more and more equity in your home. And one of our incentives is actually providing you with a maintenance credit for your first 1 to 3 years, depending on which unit you purchase. So you're getting that back as well. Your total net return is $19,600 in your first year, which is equivalent to about nearly 10.5% return on your cash as an investment. Now, don't forget that over the 4 years between when you're buying now and the time when the unit is completed and ready for occupancy, even at a 4% interest rate at a 4% growth rate per year, you would have made about $160,000 to $200,000 on this unit in appreciation between now and when you occupy. And in that first year where you're renting and making 10% on your money, which is a great return, you're also gaining more equity in that time. So when you build in the enhanced level of equity, now your first year return is $67,000 and it's 35%. Unlike the stock market, unlike other more riskier markets, there is virtually no risk here if you're a medium to long-term holder in real estate. If you believe that real estate is the best investment vehicle out there, this is why. If you don't know why, speak to your agent, speak to your broker, speak to us. We're happy to help clarify and educate you as to why real estate has been proven over centuries to be the best form of investment and wealth building over time. So if you're not in the market, make sure you get in. And if you are in the market, really consider coming in again, because this is really a great time. On a 1-bedroom Influx, we've done the same calculation. As you can see, priced at about $700,000 with about $140,000 down. Again, only 5% down per year, so it's pretty easy. Monthly mortgage projected at just under $2,500. First year rent will be just around $30,000. We've taken away the mortgage, the maintenance fees, the property taxes, added back the mortgage principal and your maintenance credit, and you're seeing about a 7% return, which is pretty good considering you're taking virtually no risk. 7% return on your investment, and when you add back the capital appreciation, you're seeing a return of about 25.5%. And again, you are not doing anything. It's not something that you have to proactively manage. For 4 years, you're really sitting idle. In 4 years, you could decide, do I want to assign my unit or do I want to become a landlord and hold it for the long term and make that income and build that equity? Number 2 reason is master plan community growth. And this slide is incredibly important because this is where we talk about why invest in a master plan community versus a standalone building. So we've done a ton of research. We're happy to share charts with you if you need. But what we found is that 16% per year is the average annual price growth in master plan communities. 16% per year. Now remember on this slide I showed you a 4% increase per year. 16 is what we found to be the historical average in master plan communities. The average appreciation in a master plan community in comparison with a standalone building in the same area outside of that master plan community is 5%. Master plan communities outperform standalone buildings by 5% per year. If you hold the unit for 4 years, just in the increase gap, just in that 5% per year extra that you're making on your master plan community investment, that alone just doubles up your deposit. Over time, over 10 years, you've outpaced the growth of a standalone building by 50% just because you've invested in a master plan community. And the question is really, why? We've distilled it down to 2 reasons. Number 1 is the infrastructure. When you buy in a standalone building on a corner or anywhere else in the city, the neighborhood is the neighborhood. Nothing changes in the area with one building coming up. You're not getting any more green space. There's no community center. There's no infrastructure that comes with it. When you're investing in a master plan community, you're investing in a unit that's surrounded by tens and sometimes hundreds of millions of dollars in up-and-coming infrastructure investments by the government, by the private sector. And when infrastructure is being built around you, that is a massive driver for appreciation. Standalone building appreciates just by the market appreciation, while master plan communities appreciate by the market appreciation with an additional layer of appreciation coming from the infrastructure that gets. The second point is that there is an alignment between the developer and the early buyers. As an early buyer, you want to make sure that prices keep going up. Guess what? The developer wants to see that same growth because you own one building, but the developer still has to sell another 2,000 or 2,500 units in that same project. So if they get another 10 or 20 or 50 or 100 or $200 per foot, you get to benefit that on one unit, they get to benefit from it on 2,000 units. So if you do the math in your mind, you're talking about potentially tens and hundreds of millions of dollars in additional revenues for developers. So they want to see prices growth. They have a power, though, that no one else does, which is they're in charge of the supply. If the market is slow, they won't release their next building, putting pressure on supply, and you get to benefit that as a buyer because there's less supply in the market and prices are increasing. When the market is hot, the developer launches a new building at significantly higher prices than what you've bought at, and you get to benefit from that increase as well. So you have an alignment with the buyer, with the developer. You're essentially partners in what you want to see and where you want to see values go in the community. So partner up with the developer and buy in a master plan community. Finally, let's talk about what a master plan community means here. In Galleria, we have 8 buildings with 3,000 units, nearly 3,000 units, making it the future home for 6,000 to 8,000 new people. We have a massive retail component, 300,000 square feet of retail at the base of every building. 21st century oriented retail, stunning, strong anchor tenants, beautiful, enhancing your lifestyle. Come and have dinner at a restaurant, have lunch with friends on the patio. We have stunning green spaces. Galleria is the home to a brand new 8-acre park. To put it in context for you, 8 acres is 360,000 square feet. Now, how many of you can say that you know a brand new park that's 360,000 square feet coming into the city? Very, very few, if any. Galleria, the developers behind Galleria, ELAD Canada, had committed to the city 40% of the landmass of the Galleria master plan community is dedicated to the park. And what that creates is green spaces. It creates a destination for people from all across the city to come and have a picnic at Galleria in the park. Come to the retail. We have beautiful community spaces, a brand new community center that's coming in, 95,000 square foot community center, state of the art with programming, running tracks, swimming pools, even a daycare because we're seeing a massive influx of new young families coming into our neighborhood, a daycare for them. There's even outdoor programming. In the winter, you'll have an outdoor ice skating trail where you can come in and lace up your skates and go for a little skate outside. So we're trying to think of everything, trying to think of all the ways to make Galleria, your future home, your future investment, make you money over time. Finally, transit. We're close to both the Bloor subway station and the DuPont subway station. We're on two major bus lines, being the Dufferin and the DuPont lines. So we're really putting you in the center of in a centric location where you can hop on transit, hop on a subway, hop on a bus, and get anywhere you want in the city. Now, for your buyers, or for those of you who have joined us who are buyers, for a limited time, we're offering unprecedented incentives. Unprecedented incentives for Galleria 1 and 2. You're buying with only 5% down per year and only 15% down total until occupancy. $5,000 is due upon signing. The balance to 5% is due in 30 days. Your next 5% installment is not due for a full year, and your 5% installment after that is due in 26 months. That's 15% down. That's it. That's all you need. If you're purchasing a unit that is 800 square feet or larger, you could actually qualify for a friendlier deposit structure, being only 10% down. So you can literally buy a $900,000 unit with $90,000 down for 4 years. When you're talking about leverage, if you have access to $90,000 or $100,000, the best value actually resides in some of the larger units in a project. Only 10% down, $5,000 due on signing, balance to 5% in 30 days, and another 5% in a year and a half. And then nothing more until occupancy, which again is scheduled for 3.5 to 4 years from now. Finally, our biggest incentives is the 1, 2, 3 live maintenance free. It's valued at up to $25,000. If you're buying a 1-bedroom or a 1-bedroom unit type, you get 1 year of free maintenance with it. For your 2-bedroom units, you get 2 years of free maintenance, and 3-bedroom units get 3 years of free maintenance. So if you remember that slide that we showed you before with the returns, on larger units, that's a 2 or 3 year pretty much guarantee with the maintenance being incentivized. We're also capping development charges. We're offering free assignments and the right to lease during occupancy. And finally, parking has been reduced temporarily from $60,000 to $50,000, and on a limited time basis, first come, first serve, is also available for purchase with any unit. Important. Our presentation center. So we built a beautiful state-of-the-art presentation center. I'm here today, 6,800 square feet, stunning, probably one of the most spectacular ones that I've ever been to. Our presentation center is open now by appointment. Masks and sanitizers are available for anyone who needs them. Surfaces are cleaned multiple times daily to make sure everyone's health and safety. And we can offer private appointments or small group appointments if necessary. In our presentation center, which we encourage you to come and visit, you'll find community scale models, building scale models, interactive touchscreens, a fully furnished model suite. You'll get personal tours by our team. We're open every day, Monday to Thursday from 12 to 6 p.m. We're closed on Fridays and open again Saturday and Sunday from 12 to 5 p.m. So please make an appointment and come down here and check out this opportunity and everything that we're putting in front of you, because these types of opportunities come up very rarely. You want to make sure you capitalize on them when you can. On behalf of my team, on behalf of ELAD Canada and the entire Galleria on the Park, and the entire Galleria on the Park family, I'd like to thank you for taking the time to join our YouTube Live today. Please make sure to schedule an appointment, call us or email us if you have any questions. Our information is on the bottom there. And we look forward to seeing you soon. Thank you and take care.